Good day, everyone. Today we will discuss about bank reconciliation. This topic is very much related to our previous discussion on cash and cash equivalents because bank reconciliation pertains to our cash in bank. And before we proceed, let me share with you again the course outcomes. These are the same as the course outcomes in our previous discussions. However, for learning outcomes, since we will talk about bank reconciliation, we have these three learning outcomes. Number one is to explain bank reconciliation. Number two is to determine the reconciling items and the related adjusting entries affecting the cash in bank per books and per bank. Actually, for number two, we will be determining the reconciling items appearing both per ledger or per books and per bank. However, for adjusting entries, this pertain to our reconciling items per ledger. Okay? And for number three, okay, prepare a bank reconciliation. Okay, let us just have a recap about bank deposits because we discussed this in our cash and cash equivalents. So basically, we have here a check, which is our demand deposit or checking account. We also have here a passbook, which relate to our savings deposit, and our certificate of time deposit. This pertains to our time deposits account. So basically, there are three bank deposits. We have the demand deposit, savings deposit, and time deposit. Demand deposit, savings deposit, if you can still remember, these items are part of cash in bank under cash items. However, for time deposit, this pertains or this item is included in our cash equivalents. Okay? Okay, since we will discuss about bank reconciliation, why reconcile? Okay, why do we need to reconcile? Okay, first, let us define what is reconcile. So let us check the definition given by the Oxford Dictionary in terms of reconcile. Reconcile is actually a verb, and that means to find an acceptable way of dealing with two or more ideas, needs, etc., that seem to be opposed to each other. So meaning there are ideas, needs, etc., which are not in agreement. That is why there is a need for reconciliation. Okay? So reconciliation, what is reconciliation? Actually, this is a noun. According to Oxford Dictionary, this is the process of making it possible for two different ideas, facts, etc., to exist together without being opposed to each other. So it's very related to the definition in our previous slide about reconcile, just that this is a noun. However, if we are to put reconciliation in accounting perspective, or per accounting perspective, reconciliation is an accounting process that compares two sets of records to check that figures are correct and in agreement. Since we will be dealing with bank reconciliation, the records that we refer here are the records appearing per ledger and per bank. And what is that account? That is our cash in bank, particularly our demand deposit or checking account. Okay? So we will be preparing a bank reconciliation for our checking deposit. Okay, so let's proceed with our bank reconciliation. So here, you see the illustration, the bank statement should equal with our accounting records as far as our cash in bank current account or cash in bank demand deposit is concerned. Bank reconciliation, therefore, is a statement which brings into agreement the cash balance per book and cash balance per bank. So we will be doing some adjustments to come up with a balance to bring the cash balance per book and cash balance per bank in agreement. Okay, the question is how to perform bank reconciliation. Actually, it's very easy. Why? Because you only need to be familiarized with these two things, the one appearing in our bank statement and our accounting records. So here, you have to familiarize yourselves with the contents of your cash in bank, both per ledger or book balance and per bank statement or bank balance. And of course, at this point in time, you should be familiarized or you should be familiar with the entries prepared by bank every time they receive deposits from depositor, because you will be confused if you will be applying the usual entries, the usual uh, rule in debiting and crediting of accounts. Okay, remember that when we increase our cash in bank, per books we debit cash and we credit accounts receivable. However, per bank, it debits cash and it credits deposit liability and to the account of the depositor. So you may, or at times you will hear that your account will be credited. So it doesn't mean that when we say your account will be credited, your cash in bank will be decreased, because per bank's perspective, it means that your cash balance will be increased. Okay? So again, the entries every time the bank receive deposits from its depositors, we have cash and credit deposit liability. Okay. Next, how about when there is a decrease in cash in bank? Okay, the usual debit accounts payable or whatever account is appropriate, and then credit a cash in bank. Per bank's records, they debit deposit liability because that is their liability to the depositor. It's like they are just in custody of the money of the depositor, and then credit cash. So it means that a decrease in cash balance means a debit entry per bank's perspective. So don't be confused when the bank says that your account will be debited. So don't interpret it that when they say that your account will be debited, your account will increase. No, it means that your account will decrease, because in their perspective, when they prepare an entry, every time there is a cash withdrawal or check withdrawal or withdrawal against your account, they debit deposit liability account. So what they are referring is the account affected by your withdrawal. Okay? Okay, let's take a look at the cash in bank per ledger or book balance. We have here a very simple illustration. This is a T account, assuming that the corporation or the company or the entity has an account at BDO. So you have here your left side, the debit side, and right side, the credit side. So if you have a cash in bank BDO, your left side represents your collections, and that increases your cash balance. And then the right side represents your disbursements, and that decreases your cash in bank balance. So if you will get the net balance, it's 240,000, your total debits, and your total credits, 175,000. So the ending balance is 65,000 pesos. Okay, how about per bank statement? Okay, okay, this is an illustration on how the bank prepares your cash in bank with them. This is their bank statement. Okay, you will see here the date. Okay, this date is also present when you prepare the T account, also the check number. However, the description, instead of your left side and then your right side, they have this word withdrawal. And this withdrawal pertains to your disbursement of checks or your credit side. And then there is also the deposits column here, and this represents the collections per ledger. However, these deposits, these are the cash received by the bank from the depositor. And then they have here at the end of the column the balance, which represent the cumulative balance every day. Okay, so you will notice that the balance changes every time there is a transaction in your cash in bank, whether that is a withdrawal or deposits. Okay, and what did you notice? If you will notice in this bank statement, there are entries which do not pertain to withdrawal or those withdrawals with check number or disbursements through check which were in cash by the supplier, by your supplier to the bank. And there are deposits which are not uh, collections received by the entity. Okay, so you have here two items, the CM and the service charge DM. So what does it mean? So if you will prepare a bank reconciliation, as mentioned, you have to be familiarized with the contents. And then you will be comparing what items in the per ledger and what items in the per bank which are not reflected in the others records. So what I mean is that assuming you have here a bank statement, what are the entries here which did not appear in the book balance? And in the per ledger or book balance, what entries in the per ledger or book balance or in the T account which did not appear in the bank statement? And those items are your reconciling items. So in short, those items which appeared both per ledger and per book, those are not the reconciling items, okay? All others, you treat that as your reconciling items. Okay, next, what are the reconciling items per books and what are the reconciling items per bank? Okay, under the per ledger or per books balance, you have the credit memos. You also have the debit memos. And later on, we will learn what are these memos. And there are also times wherein there are errors, which will also be your reconciling item, assuming that the company or the entity committed the error. So whoever committed the error should have an adjusting entry. Okay. We also have here reconciling items per bank, and that includes deposit in transit, outstanding checks, and errors. Okay. Again, if the bank, in terms of errors, committed the error, so they are the one who should prepare an adjusting entry and not the entity or the business. Okay. Okay, let's discuss about credit memos. Okay, if you can still remember in our per ledger balance, we have the left side representing the collections. And those collections should appear in our bank statement. If not, then those collection will be your reconciling items. However, not all collections will appear in the bank statement, and that's direct credit memos. These are items that representing deposits credited by the bank to the account of the depositor but not yet recorded by the depositor as cash receipts. And what are the examples of credit memos? So we have here matured time deposits transferred to the current account of the depositor. So let's say the term of the time deposits is 3 months, and after 3 months, the depositor gave an instruction to the bank that the matured time deposit should be deposited directly to their current account. So in that case, the cash in bank balance per current account or cash in bank current account balance will increase. And for number two, note receivable collected by the bank in favor of the depositor. So let's say the the customer of the entity pay their account to the bank. So that is also a reconciling items because it did not appear in the books of the entity because it directly appeared in the bank statement. Okay, so meaning the payment of of the customer did not reach the hands of the business or of the entity, but instead it went directly to the bank as deposit. Okay, and then number three, proceeds of bank loan, assuming that the entity secured a loan from the bank, so it also increased the cash in bank balance. And for these three items, since these are the reconciling items per books, then this require adjusting entries. Okay, for number one, the entity should have a debit to cash in bank and credit short-term investments. So whatever account the entity used to represent a mature time deposit, so that is a credit. And then how about notes receivable? So since that represents collection through notes, so debit cash in bank and then credit notes receivable and proceeds of bank loan. So that is cash in bank, debit, and credit loans payable. So all credit memos should have a debit to cash in bank, particularly current account. Okay. Next, we have the reconciling items debit memos. If you can still remember, again, the right side or the credit side of the T account represents disbursements through checks. However, per bank statement, there are items not representing checks paid, and those items are the debit memos. Okay? And what are the example of debit memos? We have here NSF or no sufficient fund checks or the if thrown against insufficient funds. So assuming that your customer paid their account through issuance of check. Okay, without knowing that the check given by your customer has insufficient funds. So when you present the check to the bank for encashment or for deposit, so the check will bounce. So meaning it will not be accepted by the bank due to insufficiency of funds. So meaning it is as if your customer did not pay their account. Okay. And number two, technically defective checks, absence of signature, erasures not countersigned, mutilated checks, conflict between amount in words and amount in figures. Okay, for number one, number two, it's the same treatment. However, for number two, if you were the business, or if you were in charge, you were the cashier of an entity, definitely you will be aware of the check that will be paid by your customer. Okay, you will check the completeness of signature, you will check whether there are erasures, otherwise you will give back or return the check paid by or given to you by your customer or mutilated checks or if there is a conflict between amount in words and amount in figures. So for number two, it's very seldom that there are technically defective checks because at the entity level, through its cashier, the cashier will be able to identify whether the check is good in terms of completeness of signature, erasure, absence of erasure, mutilated checks, etc., etc. However, for number one, the cashier cannot identify whether the check has complete funds or sufficient funds, so it's not within the control of the cashier for number one. But for number two, it's within the control, right? It or Yes, it can be controlled or within the control of the cashier. Okay, for number three, bank service charges for interest, collection, checkbook, and penalty. So these are charges directly which are directly reflected in the bank statement. So the entity maybe has no idea that they will be charged with this bank service charges, or if they have an idea, they are not aware of the amount that will be charged against them. Okay, number four, reduction of loan. So if the company has a loan with the bank, then their payment for loan which the depositor owes to the bank will decrease the cash in bank balance. And for number two, it's like a auto debit transaction. So meaning the bank will automatically deduct certain amount of money from their cash in bank balance. Okay, for number one and number two, since these are debit memos, these are reconciling items per ledger or per books, the entity should prepare adjusting entries. And what is the adjusting entry? The debit accounts receivable and you credit cash in bank. Okay. And for number three, what will be the adjusting entries? Debit bank charges or whatever expense account that the company used to record is number three. You debit that and you credit cash in bank. And lastly, for reduction of loan or payment of loan, that means loans payable, debit, and credit cash in bank. So in short, for debit memos, your cash in bank is always credited. Okay? How about the reconciling items per bank? The reconciling items per bank includes the deposit in transit, and this deposit in transit refer to collections already recorded by the depositor as cash receipts but not yet reflected on the bank statement. And usually, these collections are the end of month collection of the cashier, which are too late to be reflected on the bank statement. Actually, we have here example of deposit in transit. So number one is the collections already forwarded to the bank for deposit but too late to appear in the bank statement because they have a cut-off. However, today I don't think number one is happening or is common because our bank right now has extended hours. Before, the bank the banking hours was actually until 3 p.m. But right now, if you will notice, BDO has initiated extension of banking hours up to, I think, 6 p.m. or 7 p.m. And number two, undeposited collections or those still in the hands of the depositor or cash in hand waiting delivery to the bank for deposit. This is what I mentioned earlier that for undeposited collections, this pertain to the end of month. Let's say it's July, the July 31 collections. Okay. Usually that collections are still in the hands of the depositor awaiting delivery to the bank for deposit because that will be reflected the next day. The collection on the end of month, July 31, although reflected in the books as collection, will be reflected by the bank the next month. Okay. Next, outstanding checks. These are checks already recorded by the depositor as cash disbursements, but not yet reflected on the bank statement. These are outstanding checks given or checks given to the supplier or to the payee, which the payee did not yet in cash. Okay? So we have here number one, checks drawn already given to the payee but not yet presented for payment. Correct? And number two, certified checks. A check where the bank has stamped on its face the word accepted or certified indicated sufficiency of fund. And it says that for certified checks, it should be excluded from outstanding checks. Okay? Let's move on. How to perform our bank reconciliation. So we have a part two for this one. So at this point, let me stop our discussion to continue. We'll have another video for bank reconciliation, sample illustration. Thank you.